Let's go deeper into fixed income. And with that, allow me to introduce our next speaker. So he is Deputy Chief Investment Officer and Head of Fixed Income at SunLife Investment Management and Trust Company. He oversees practically all of the firm's investments, ranging from fixed income, money market, equities, and global fund of funds. His financial market experience spans 16 years, and he is consistently recognized as one of the most astute local bond investors in the Philippines. So to share his insights for today, let us all welcome Mr. Ritchie.
Hi, thanks, Serge, for the kind introduction. So thank you again for the invitation. So let me share the screen. No? I think someone's sharing screen. No? So just wait. Okay. Just wanted to make sure everyone's able to see the screen. All right. Okay. Given that I see the audience is very much engaged, a lot of questions, I'll keep my presentation short so that I'll spend more time with Serge on the Q&A sessions. And judging from the survey shared a while ago, I think a lot of you guys are looking into going into the income paying products, no? And that would really mean in terms of the fixed income world, is it time for us to invest in these products, no? And here I'd like to spend on pretty similar with what Zach mentioned a while ago on the three things that we're looking out for, right? On inflation, growth, and how the central banks could react to it. So for us here in the fixed income market, I'll be touching on both global and local since they are very much related to each other. What we're seeing right now is consistent with what Zach has seen over in the global market, wherein inflation has been decelerating. So we've seen that both in the US and in the local, with local numbers now actually is already below the interest rate. No? What this means is we have already a positive yield, real yield here, wherein the interest rate is higher than the inflation rate. But we think that there will still be some hurdles, but it's very much encouraging to see the deceleration. And with that deceleration in inflation, the central banks can put on hold their hiking. And we've actually seen that over the past few meetings. As a matter of fact, just today, BSP again held their interest rate at 6.25%. And our view there is we foresee them to keep that on hold in the near future. Okay, but this one also highlighted a while ago, core inflation has been quite slow to come down, and this may cause markets and the central bank to be on hold in the near future. And the Fed has been very much out there saying that it will be data dependent. They'd want to see inflation go to their target of 2% before they even think about cutting rates. And earlier today, BSP governor mentioned that he would want to see inflation go down to below 4% for 2 months before entertaining any cuts for their move. No? And right now at 6.1%, we're still not there yet, but our outlook is for inflation to go to 4% sometime in the fourth quarter of this year. Then on the flip side of inflation, there will be the growth. And for growth, our probability for a US recession is at 63%. So this is based from our guys in North America, where they track this. So it is higher than the usual. But the good thing here is same view with BlackRock, wherein it won't be a hard landing. It will be a soft landing. But of course, there are a lot of risks happening, most especially recently with the banking crisis in the first quarter of this year. That may cause some more of the recession pressure in the market. And that will cause, with this recession, that will cause the central banks and the market to price in the near future the cuts. As you can see here on this chart, on this table, on the lower right, where the implied Fed overnight rate is already pricing in a cut by next year. One cut there, no? So this reflects the lower inflation outlook and the recession coming in the US. For the locally, local growth has remained strong, no? The last print was at 6.3%, and it's quite good to see that it has remained strong. And we think that with that one, we think that the BSP is really looking more on the inflation, no? And that they have that bullet to really cut rates if inflation go below the 4% threshold that they're looking at, no? But what's interesting here is looking at the market, as you can see here on the right side, only minimal cuts are being priced in today. So right now, the overnight rate, it's a 6.25%. You can see here that the market is only pricing about one cut, no, for the market. So it's at 5.9, 5.8%, coming from the 6.25% current levels. And for the long term, you can see here that it's actually not yet inverted, unlike in the US market, where in the 10-year is at 3.7, while the overnight rate is at 5 to 5.25. So here, at least in the Philippines, locally, there's still some attractiveness when you go on the longer term of the yield curve, as it's still yielding around 5.8 to 6%. So very much flat, but at least not inverted. No? What are the risks to our view? Of course, the risk here is if inflation continues to be stubborn. And a while ago, it was alluded that inflation, especially core, can be sticky, especially if it's based on the service. No? And with unemployment still very low, labor market would remain tight, and that will pose some stickiness, especially on the core inflation numbers. And with that one, with inflation very much still high there, and if we don't see it go towards the target of the Fed, then the risk there locally is Fed may hike, and it will affect also BSP, as it will affect the interest rate differential that will really factor in on how the peso could perform versus the US dollar. So as for the interest rate differential, if you recall, last year, the interest rate differential is around 2%. This year, it's at 1.25%. So lower interest rate differential, that's why we saw the peso weaken by about 8.5% last year. No? And the government at BSP could like to see it more or less stable. They don't want too much weakening from the peso or too much strengthening in that sense. No? So our view here is they'd want to maintain that interest rate differential of about 1 to 1.35%. So if the Fed moves, BSP might move also. No? If they hike, they cut or hold, they will follow suit. And that's very important because it will affect capital flows, trade flows, which is very much important to the local economy. One thing that's good in the Philippines is, well, here in the risk, is we've seen that inflation in the Philippines reacts faster. And it reacts faster mainly because of bigger commodity dependence, no, for the Philippines. But the risk there is if, again, commodities would go up, that may cause inflation to spike back up. No? But recently, we've seen that there are a lot of measures that were taken that can keep inflation in control, like more importation, earlier importation to combat weather-related spikes in prices. No? And as for oil, even though the OPEC has been cutting production, we actually didn't see prices spike up, no? Mainly because of the market pricing in recession in the world economy. So it's now quite stable around 75 to 80 levels. No? And it will also help locally our inflation numbers. So summary here is we think that the decelerating inflation will keep central banks enough bullets to pause and hold rates, and they're very much near already their terminal rate. No? So for the Fed, that's 5 to 5.25. For the BSP, it's at 6.25%. And the next time we'll probably talk again here would be when will be the cuts be? When will the cuts come and how big will they be? So for the BSP policy, they will factor in Fed, and of course, they will look into that better inflation for that to really happen, the cuts, I mean. And the local Philippine curve here is still giving a lot of opportunities, as we can see that it hasn't really priced in a lot of cuts yet. So once that happens, we can expect yields to go lower, and as yields go lower, prices will go up. No? So what's our strategy? For the funds, our strategy is we'd want to go overweight on duration. This means that we'd want to bet more on the long end, more risk bets on the fixed income, because we think that there's room for yields to go down and prices to go up. A while ago, I think there was a chart there showing if the yield you're buying into is 8%, I think a lot of the more than 90% or so saw that they got good returns, close to double digit. No? And that's where we are currently as well right now. Last year, we suffered some losses because yields went up, but now yields at 6% levels, it's actually quite attractive to go into that, as we can expect high yields if you're a hold to collect investor, or if you're after price gains, there's that possibility to see those price appreciation as yields go down and prices go up. For the US rates, we are trying to stay nimble. We would like to buy on pessimism and sell on optimism, because right now the US Treasury bond is trading around level of 3.6 to 3.9. It's about that. And we see a lot of noises, as the title of this presentation, of the theme of this call is Embracing Uncertainty. There's a lot of uncertainty happening, especially on the Fed talks. And just last night, right? Again, the Fed sounded like they're hawkish, but we would really look into capitalizing on those opportunities and buy on those pessimism, because our outlook for the year is inflation is decelerating, and that will provide a lot of opportunities for the fixed income market. That's the end of my presentation, and I'll welcome questions from the audience. Thank you.
All right. Thanks a lot for that, Ritchie. Very, very insightful. And I guess to get the ball rolling with our Q&A, let's divide the discussion first between global and local fixed income. So I guess first on the global scene, particularly in the US, so you touched up on it, no? Look, can we really expect the Fed to remain with that 2% inflation target? Or should we maybe expect a more realistic 3% level? And I guess like during your presentation, you mentioned a lot about inflation. So I guess within our audience here today, I mean, a good amount of us, we are familiar with equity investing, but not so much with fixed income. So maybe you could also explain while answering this question, why is inflation actually so important when we're talking about fixed income?
Okay, so probably let me answer that fundamental question first, no, on the inflation and why it's important for fixed income. For inflation, that's one of the measures that's one of the goals of the central banks. They'd want inflation to be in check. They don't want too high. They don't want too low. The other one would be on the growth. No? So if it's too high, what they will do is they will raise interest rates to combat that high inflation and bring it down. If it's too low, they will do the reverse. So what will happen here is, it's very important because it affects central banks, right? So now we're seeing high inflation last year. So what happened was central banks hiked interest rates. So those higher interest rates, what did we see in our funds for the bond funds? We saw prices went down. So remember, if yields go up, prices will go down. So if interest rates remain high, yields will not go down because the central banks will not cut rates. So that would mean prices would remain there. They won't appreciate. But if rates would go down, like in your first question, if US rates will go down to the 2% level, that will give comfort to the Fed to cut their interest rates. Because right now at 5%, it's quite high, no? Compared to the 2% inflation target by the US. So you can imagine that if inflation goes down to 2%, that will give room for the US to cut their rates closer to 2%, probably about 2.5 later on. Sorry, not later on, but probably the next few years. Then that will provide that capital appreciation. That's why we're very much in focus with inflation. Now, on your first question, we think realistically, probably a 2% that will not happen this year for the US, mainly because it's quite sticky. If you look at the core, it's still at 5.3%, and it has been hovering about 5 to 6% for the past few months. No? So based on our simulation, we're probably looking at mid of 2024 before they can really hit the 2% inflation target.
I see.
Where they can really cut more. But right now at 5%, they already have that room to cut, no? In case they can really see or they're convinced with the deceleration of the inflation numbers.
All right. So at least tama ba, Richie? Like let's say for the benefit also of our audience. So if I'm going to be buying a bond fund today, it's going to be more ideal for me to see inflation in the US go to 2% versus hanggang 3% lang. And the faster it goes there, tama ba? The faster we could also realize our capital gains if that were to happen.
Correct. That's correct in a nutshell. But I would say that even though if it goes to 3%, it will still be favorable for the bond market. No?
I see.
It's still going down and it will still give that possibility of a price appreciation.
Okay. All right. Sige. So yeah, maybe we could move on at least with some of the questions from our audience. Sige, let's just see what we have here. So we have questions here about asset allocation. So this one from Leandro, I believe a lot of the people here watching could relate to this. Because the stock market has remained bearish contrary to expectations, does it make sense to shift cash to fixed income? And then also maybe as a follow-up to that, given your position as deputy CIO, what could you suggest as the best allocation of assets this third and fourth quarter?
Okay. So I would be remiss if I don't answer this. It will depend also on your risk tolerance, right? So because it will really depend, especially if you're an investor, it's not just a short-term trading. It will really be on the long term. No? But if we're just looking at current opportunities right now, actually, we also handle multi-asset in SunLife. And currently, right now, we're overweight on fixed income and neutral on the equity market, no? Due to the reason cited a while ago as well, no, by the first speaker. So with that, I think you've also shared last year in November, you've shared that the call was to go overweight on fixed income, which turned out to be quite good, no? Given that equity markets has been more or less flat and slightly negative, while fixed income, they have been up by 3 to 6%, depending on the if it's long-term 6%, if it's medium-term, short-term, it's about 3%. No? And as I've mentioned in my earlier slides, in my presentation, the market hasn't really priced in a lot of those cuts. At most, just one. And if this happens, especially with all of these uncertainties, now market is again talking about a hawkish cost, no, from the Fed. So they're again pricing it, okay, probably there will be one more hike for this year. So this is causing the market not really to fully rally. And this provides opportunity for the market to still for the fixed income market to still see some more returns for the next few months. But I would say that it's quite hard. If it's third to fourth quarter, probably right now, that's my answer. Fixed income over equity. But I will be also quick to say that it can shift quickly, because when we see fixed income markets rally fast, rally hard, it will actually make bond yields less attractive compared to the equity yield, no, equity premiums that we're seeing. So that's where the hand of the baton, so to speak, will happen when we will shift now to equity, given that they're more attractive valuation wise, PE wise, compared to the fixed income market. But now fixed income still looks very much attractive with what's being priced in the market and our outlook of a deceleration of inflation, and for the central banks to keep on pause and probably cut rates later in the year or early next year.
All right, great. Thanks for that answer, Richie. Maybe we could flash the next set of questions. All right, so ito mukhang medyo mahaba. Questions on investing strategy. So this one from Randy. It's a bit more, I guess, of a general question. So maybe this alludes back to your, I guess, position as CIO. As an investor, how do we improve our strategy in investing with this market situation? And I guess for Ruel, is it good to start investing again in this time? So maybe we could treat this as probably from the perspective of you're in cash and you don't know, I guess, what to do. Do you enter like the financial markets at this point?
Right.
With all the noise out there. Yeah.
Okay. Yeah, if you're in cash, I totally agree. A while ago in the earlier slides, now we're in, you're missing out a lot of opportunities, because in cash, yes, it's protected, but now with prices low, with yields high, you actually want to get into the action, no? Slowly, if that will based on your risk tolerance. So that's one. We'd like to participate. And a while ago, I heard the cost averaging. That's something that can fit for some investors as well, especially if you're coming from 100% cash. And another one that I do want to highlight that's been very much helpful in our portfolios is diversification. Although last year you can argue that both equities and fixed income went down, in the usual markets, actually, that's not usually the case. Sometimes, usually, if fixed income are down, equities could be up. And if vice versa, if equities up, fixed income would be down, no? And to further that, I think also look at the global markets, because as you can see this year, fixed income are up, local equity, neutral, slightly flat or lower, but global equity are actually up, no? Because of the AI-driven rally and that stuff. So it's very, very critical. And lastly, there on the diversification still is even on the peso, dollar peso, that can also drive some returns though in your investment. So one word, diversification is a key strategy in investing, especially in uncertain times.
All right. Thank you so much for saying that, Richie. It really actually echoes what what we're trying to achieve with this session this afternoon. So you guys, you heard it. Diversification. Please keep it in mind. I'm just looking through some of the smaller questions here in the side, and something caught my eye. Severino Jose had a question there, and I guess this also is something that I would like to ask in terms of bond investing. Do you like just treat it as a one-time, one-shot deal? Like let's say you decide you buy a bond or a bond fund, rates are at 6.5%, you buy it, or is it also something that you could, like it's a cost average over time? Like let's say, because a lot of our investors do that every month, but they put in money, they buy an index fund or whatnot. Is that type of strategy also applicable for bond funds?
Yeah, it's applicable, especially for bond funds, no? I think the HTC hold to collect, it's more popular for those investing in direct bonds, because for bonds, especially for corporate, once you buy it, the liquidity is not really that great compared to equity. So it's expected that you will hold it, no, until it matures. So if you locked it in at the current rate of 7-8%, then you will enjoy that, no? Of course, you won't really take a look at the market price because you don't have any plans of selling it.
Yes.
Now, I'm saying that for the bond funds, it's actually good to look at cost averaging, and it will make sense because as the fund manager, we're very much looking into those. Is it time to go overweight, underweight duration? or is it good to position on the short end or on the long end where there are more opportunities, no? So we're not just relying on the yield that we can get, no? For example, the yield say that it's about 6%, you will enjoy 6%. What the bond funds would do, they will look at the opportunities and trade the market also. So sometimes it can be front loaded, especially if the market hasn't priced it, but then a rally, huge rally happen, so it can actually get that return faster than holding. No?
Okay, great. Yeah, thank you so much for that. So there, at least we heard it. So it's not like it's just a one-time, big-time thing. So I guess the strategy here is you set how much you want to put into bonds, and like as your income from your business, from your work comes along, just feel confident and free to just continue putting in funds also in bond funds, because the fund managers there also manage it to help derive, I guess, maybe capital gains as well.
Yes, that's correct.
Yeah. All right. So maybe we could move forward with some live questions that we have on hand. So team, if we could just show that. So this is from Trina. With US Fed recent intention to hike rates some more, how will the Philippines be affected by this?
Okay. So the Philippines will be affected by it if the Fed does hike rates, no? Because it will affect the interest rate differential. But what's good there is there's still some room. We're at 1.25%, 125 basis points higher than the Fed, no? So we can still hold on. I think 100 basis points difference will not be too detrimental yet for the peso, no? But definitely, if the Fed hikes, there's some probability that the Philippines may hike also to follow suit.
Actually, sorry, just before, out of curiosity also, before we move on to the next question, this is personal question that I've also been trying to ask the people in our team. Like, what would happen in this type of scenario? Like, what if the Fed raises rates and then the BSP does not? Like, let's say for the July meeting, that's what happens. Or, as you mentioned earlier, Governor Medalla says for 2 months of 4% below inflation, they might cut.
Right.
Are there?
Yeah, we've actually seen that last year.
Okay.
So last year, again, as a reference, 2%, started at 2%, then it went all the way down to 125. So that's 75 basis points of unmatched hike that the BSP decided to do. No, at what we've seen, 8.5% depreciation from the Philippines for the peso, and we've also seen outflows on the equity market. For the bond market, I think most of the players are really local markets, so it won't really affect that much in terms of flows. But yes, if it's quite huge, then that will have a negative effect on the peso depreciation and also on flows. But now with 125 basis points, I think it can go down to 100, and the market won't really, react too much. Although probably there's some knee jerk there now.
All right. Okay. Great. Thanks, Ritchie. Maybe we can see the next question here. All right. So yeah, what do you recommend between preferred shares and fixed income today? So I think at least from a yield perspective, they're a bit similar. So what do you think?
Okay. Yeah, I think this one, it can vary. For preferred shares, it will also depend on the issuer, because the yields, based on my last scan, it will range from 4 to 7%. So it depends also on the issuer, no? But definitely, especially with the tax advantage, given that preferred shares is 10% for individuals, while for fixed income, it's at 20%. If you look at it on a net basis, just compare what's higher, no? But usually preferred shares will be higher compared to fixed income in terms of yield, because it's expected that they should give higher returns given that they're equity, not fixed income. And if you look at maturities for fixed income, it's more restrained. Wherein there's a maturity of 5 years, 7 years. Well, for preferred, depending on that, it can go all the way like a perpetual or what.
Yeah. Okay. Thanks for that, Ritchie. Yeah, so I think on the risk scale, preferred shares tend to be a bit riskier. So they're subordinate to fixed income.
Yes, that's correct. That
Yeah.
also. Yeah, good point.
Yeah.
Yes.
Okay. Yeah. Oh, kasi ako nakita ko I mean, yeah, basta hindi ko na share, basta may binili akong preferred. So, last year, it's down 70%. So
yeah, and even not only on volatility, but as you mentioned nga, if the issuer goes bankrupt, defaulted, first would be fixed income, next would be the preferred shares, and then lastly the common shares. No, so it's justified why they will be yielding higher. So just compare. Is the premium already better compared to the fixed income? No, so this is on top of what I mentioned a while ago of in terms of maturity, usually longer talaga yung preferred shares compared to fixed income.
thanks, Ritchie. Okay, can we see the next question, please? All right. For fixed income assets right now, is it better to get into short term or long term? So good question from Anne. So what do you think?
Okay, yeah, that's a good question. No, for the local market, given that the yield curve, as you've seen a while ago in my chart, no, it's flat. It's not inverted. The normal kasi for if they're not aware, no, yield curve is as you go longer into the tenor, it will be higher, right? Yeah. So that's the normal curve. It's like a check mark. But if it's flat, then just flat. If it's inverted, it's going down. So given that there's that premium on the longer term, and we think that rates are peakish right now at the peak, then it's actually a good idea to lock in. No? And if you bet on the long term, if yields go down, the price impact will be actually higher on the long term compared to the short term. So there's that risk element also because it will be more volatile for the long end. But if the call is right, then you will be rewarded as well. And given the view right now, I'd say that the longer you can lock in or you can take a bet, the better. But if you're the issuer, if you're the one borrowing, of course, you don't want to borrow for the long term. You're more on the short term. So that's the balance that hopefully you can find the good equilibrium. No?
Yeah. Thanks, Ritchie. So I guess the answer there, it's not really cut and dry completely, but like at least if you ask him long term to at least just be able to try to lock in the higher.
Right. Yeah, and also check the credit, of course. You need to look at the credit because I assume it's not just the government that you're looking into. There's also corporate. So the better the credit is, then the more, I guess, more comfortable you'll be to invest longer. No, but if it's somewhat you're not too comfortable, then the shorter it is, especially if the premium is not that big. No.
Okay. All right. Thanks, Ritchie. Okay, can I see the next one? Next question, please. All right. So, what's your forecast for the peso dollar exchange rate given interest rate movements from Victor?
Yeah. Okay. We think that the interest rate differential will not change a lot this year, unlike last year, where we've seen the 8.5% depreciation because of the 125 basis points. It's 75 basis points lower, no? So, medyo no? Kind of aligned 7.5 lower, 8.5 depreciation. And if it stays there, probably we would see the peso just range within 54 to 56.5 levels for this year.
Okay. All right. Thanks, Ritchie. Okay, do we still have other live questions? All right. Okay, so maybe this could be the last live question. So yeah, so this is the last one indeed. So is it okay to concentrate to REITs as my portfolio to fixed income instead of bonds? So I guess, sorry, maybe Cornelio is asking here is, yeah, is it okay to concentrate on REITs for my portfolio as his fixed income exposure instead of bonds?
Okay. Yeah, that's a very valid strategy, no, Cornelio. So it's like for REITs kasi, people would buy it for the yield, right? So right now it's about 7%, 7.4%. So that's a good alternative for fixed income, no? If you just want to enjoy the dividends. The risk there could be that yield can differ. It will be fluctuating. It can be 7% now, but it can be 5% next time, etc. No? Because of the price movement of the REIT. You can look at the REIT prices, right? It can change much. There's really a market there, and there's no set maturity. Unlike for fixed income, if you're a hold to collect, then it's really more of you will just stay there and hold it there and enjoy the whatever coupon it is when you got it, the yield, no. But for REIT, it can vary, and there's some risk also on REITs. So pretty much similar to our conversation a while ago with preferred. So for REIT, higher risk there, and some of the risks would be, especially right now, it's dominated by office REITs, right? And we know that with work from home, like right now, working from home, not sure if you can hear the drums outside. It's my kid playing drums right now. No? Since yeah, but yeah, with work from home, some of the offices are challenged, vacancies, and that will put a challenge on the office REITs, no, and also on the asset injection plan, etc. So those are the risk on REITs. But if you can tolerate that, yes, definitely it's something that's also attractive, no, especially if you already factor in the taxes.
All right. Thank you, Richie. Yeah, that's all the questions we have, at least for this segment. So similar with Zach, would you have any parting comments or remarks you would like to leave our audience?
Yeah, so embrace the uncertainty by diversification. Look into fixed income, equities, global, local, and just do cost averaging if that will bring you to your sleeping point.
Okay, great. Thank you very much, Richie. We appreciate the time, and please take care.
All right, thanks also, Serge.